Hi guys, welcome to today's session. I'm going to give everybody a moment to join. If somebody in the Discord could confirm whether you can see my screen and hear me, that would be massively appreciated. I'm going to repeat the message I gave at the start of yesterday's webinar, in that there's been work done on my estate recently, and I think they've messed about with the internet. And so on Discord specifically over the past week or two, the connection has been a little bit shaky. So if at any point in fact, what I'll do is I'll grab the YouTube URL. So if at any point the connection starts dropping out on Discord, please feel free to move over to YouTube. But I think Flow Trader says we can hear and see you. Rob says, yeah, can. Perfect. Can I have a look with you at SPWL for a couple of minutes? Of course you can, Rob. I think that I'm waiting for Vincenzo to come through on YouTube, see if he's here today, and we'll do an analysis on his Darwin. But if not, I'm more than happy to do SPWL. So for the guys who haven't been to this session before, the whole purpose of this is to try and look at different variables that you might not have looked at in the past to try and improve your trading strategy, or to optimize it in any way possible. What I always say is most traders are very technical heavy. They learn a technical pattern or an indicator or some form of, strategy or system. And it all boils down to the rules that they set out for themselves in terms of, I see ABC pattern, I go away and do X, Y, Z. When in actual fact, when you're trading, there's 1,000,001 different variables that you should be taking into an account, and a chart or a technical variable is just one of those million. And so if you're ignoring the rest and saying I only do what this chart pattern says, you often kind of overlook some low-hanging fruits that you can really take advantage of or cut if they're not working. And that's the purpose of today's session. It's not for me to say your trading strategy is bad or good, or look for any advancements that you can make on your systems, but it's to highlight any variables that I notice a low-hanging fruit. Flow Trader says, I am institutional technical heavy, aka smart money, but more ADV. I'm not 100% sure what ADV means. In terms of smart money, I mean, be careful the way you phrase that sort of thing, because you can kind of get in your own head, I found, with labeling things smart money. But when we go through this, you'll understand why I say that, because the most, okay, advanced, got you. The smartest thing, in my opinion, that you can do is go through your data and understand where your highest expected value is and where your lowest expected value is. And that's really what I would deem to be a smart person or a smart money person. Like a technical pattern. And I'm sorry, I don't mean to sound it like I'm putting you on bash here. It's not that at all. But a technique to be classed as smart money, in my eyes, is difficult to comprehend. It's because people say what I do looks like smart money trading. Yeah, okay. So there's a huge wave, right, in the retail space, where people are trying to hunt what quote unquote banks do. You can't see me on Discord, but I'm doing like quote marks in my hands, right? And in reality, like, I work with a lot of professional traders and guys who have worked at prop desks, hedge funds, investment banks, and the whole idea of trying to copy somebody like that is just completely redundant. These guys are playing with far more amounts of money, like far larger pots of capital. They're not able to execute in the same way that you would be able to anyway. So trying to mirror somebody like that is it's just very, very difficult to do. And kind of, you don't even have to do it. Anyway, rant over. Like I say, that wasn't a bash on you. It's just be careful of the wording. What I want everybody to take away from this is how to think like a professional. And trying to analyze the flaws in their processes. And like I say, a huge flaw that I see is people rely too much on one singular variable, whether it's macro trading a chart, or whatever it may be, when in reality they should be analyzing so many different aspects. Yeah, very different, whole beast on its own. Yeah, 100%. Right, Rob, let's have a quick chat then. It doesn't look like Vincenzo's jumping on the YouTube stream, so we can stay on SPWL if you want. We can have more of these sorts of conversations about strategy. The main thing about these sessions is I like to keep them fairly relaxed. So if there's topic that you guys want to discuss, of course, please just put it forward. And if depending on what platform you're watching this on, please just pop a comment in if you want to have a chat or have an idea. FJ Universe, thanks for the video. It's an absolute pleasure, dude. Joined here from Rob, my Discord, playing up. Oh, how we doing, Rob? Let me put the YouTube. Was it my audio that was playing up, or was it your Discord? I just want to double check. But yeah, I usually let these stretch on past an hour as well. But today I actually have a call at 5 p.m. UK time, which is in 50 minutes. So I will have to cut this at 5, unfortunately. Whereas usually I end up rambling on about statistics and different variables for a lot longer than an hour. So, Rob, anyway, let's take a look. I presume there's something that you wanted to talk about. Soon as though you asked to take a look at SPWL. So I'll wait for you to pop a question in or pop whatever you want to look at, or if you just want me to go through it. I don't know if that's what you want, but this must be getting on now, right? So December, started December. Just your, oh, it was your screen that was playing up. Okay. Yeah. Is there anything specific that you wanted to take a look at? There's a big period of inactivity there. How long did you not trade for? Just over a month. It's almost 2 months, isn't it? That? I'm just waiting for Rob to reply back on YouTube. Come here. I'm presuming Rob's having some issues at the moment. He's jumped from Discord to YouTube and hasn't commented for a few minutes. Here we go. I took a big loss today, 2 losers. One hasn't shown, but was a bit concerned. All I'm going to say is half a month at one point I didn't trade. Okay, so you took a big loss today, 2 losers, one hasn't shown. What's your closed exposure? So for down in the corner, because this is what you asked earlier, wasn't it? You asked what the closed exposure meant. I'm presuming you mean it's not shown in here. So if you look in the live trades box, is it shown in here? Like, does that show you your that trade? You say it's a big loser. Your Darwin's not done too bad. Let's take a look at your VAR. $320. I didn't realize she was operating at such low risk. That's good. Flow Trader asked, so I'm told to scale down my lot size. Would you reckon doing 1 lot less per trade would be okay to not spook the risk engine? Although I made 8% after 3 weeks, but lot size was 10. Want to bring it down to 1 lot now, but I'll make 0.8 on MT5. Flow Trader, do you have a live Darwin? And I'll take a look at it for you. No, you don't. Are you still in calibration phase? It's done. What's your ticker? Are you in the period where it will be created on Monday? Yeah, August the 4th. Okay, so what's your current return, and do you know your max drawdown or what your max drawdown has been? And I'm talking at Signal account level here, so on your MetaTrader. I mean, even with those numbers, I won't be able to accurately say what you know what the risk, how the risk engine is going to interpret your system. The only thing I will say is, like, you don't need to be risking a large amount here. Your Darwin is risk adjusted, so whatever you risk, or however you operate at signal account level, the main thing is the quality of your trades, right? So our risk engine will always adjust your risk on trade open, and it will also manage the risk of the position on your behalf whilst it's open as well. So you aren't any better off by risking more at signal account level. The only time I tell people to risk a little bit higher on their MetaTrader is if you want to use that track record from a MyFX book or broker statement perspective to kind of, you know, go and get a job, fund elsewhere. But even if you risk 0.1 lot and you make 1% per year, you know, as long as your risk adjusted returns are fine, you know, you might have only made 1%, but your drawdown might have been 0.001%, right? It's still a fantastic risk adjusted return. So it doesn't really matter how much you make or how much you draw down. But specifically here, where we risk adjust everything anyway, there's just no necessary. There's not a necessity for you to risk higher or make X amount of return, because it really doesn't matter. The main thing is you providing the highest quality trading signals that you possibly can. So if you do want to scale down to one lot, which I would recommend, like I don't see there's any point in risking 10 lots. I would say do it slowly, like spend 2 or 3 months slowly bringing that down. So instead of dropping from 10 to 1 straight away, which will give the risk engine, it won't spook it, but it will give it a bit of a period where your trades aren't accurately risk adjusted, because it will presume that you're trading with a 10 lot. All of a sudden a 1 lot comes through and it won't risk adjust it to the same level that your 10 lot trade would be. So if you bring it down slowly, it will keep the curve as steady and as stable as possible. I'm doing 2 lots less now. Okay, slowly bring that down. Don't do any big jumps. Go from 8 lots, then, you know, 7.9, 7.8, 7.7, and try and bring it down. So max drawdown was 4%. What did you say your return was? 8%. 10% per trade. Okay, yeah. I won't pull any punches. You're probably going to be scaled down quite heavily on that. I don't know without taking a look, because it's all calculated based on your deleverage. In fact, you should be able to find that information. So if you go onto your dashboard, and if you look on, you will be on your page here. So you won't have access to your risk adjusted statistics yet, but you'll be able to see your signal account statistics, which gives you this number. Your deleverage. Okay, so if you can find your deleverage number here, and let me know, we can kind of see where you'll sit from a risk perspective. Because if your deleverage is like 100, I can tell you're going to be scaled down massively. If your deleverage is like 1 or 2 like mine, this is a portfolio I started last month. It's a super low risk hedge portfolio, but you can see my deleverage sits between 1 and 2. Okay, so we know with that, with a 1 or 2 deleverage, if we take a look at my VAR is about 1.5 to 2%. So 1.99% VAR right now, which means my multiplier is 3.06. Okay, so if your deleverage was 10x mine, your VAR is probably going to be 10x mine or similar, and therefore your risk multiplier is going to be like mine divided by 10. So we can kind of get an idea of how it's gonna match up when your Darwin goes live. Won't be 100% accurate, of course, and I can't claim to be the risk engine, but that's basically how it works. Rob put a couple of things. Can't see any closed exposure. I think might not have updated. The closed exposure runs in real time, so this will show in absolute real time. So your current risk ratio and your closed exposure. I'm presuming did you say you closed one position, left the other one open? I think that's what you said, but I'm not 100% sure. Alan said, "Hey, love your content. I appreciate that massively. Could you review DRYX? I've traded for 3 years. Interesting. Let's take a look. DR. Do you mean you've traded on Darwinex for 3 years, or you've traded in total for 3 years? I'm presuming in total, because Darwinex hasn't been around for 3 years, but I could be wrong. Yeah, so you've traded on Darwinex for a year. FX Panda. I feel like I've looked at this Darwin before. I could be wrong, but I'm sure I've looked at this one before. So, a year, I mean, 15% return for a year. You beat the average of the S&P. It's great. Max drawdown 6.94. You've experienced less volatility than the S&P as well, so fantastic. I don't know whether you're happy with that return or happy with that performance, but to me, you've already ticked the bottom benchmark, right? Which is, do I beat the S&P? I always say to people, and it's quite blunt, but I think it makes sense. Is like, if you cannot beat the S&P, especially being risk adjusted, there's no reason for anybody to invest capital in you, in my opinion, right? Now you might disagree, but if I know that I can put my capital in the S&P 500, not have to worry about things like trader error or edge decay, anything like this, I know I'm putting my capital into an asset that is designed to increase in value over time with expansion of the economy and inflation. We know that the S&P is designed to increase. So if you can't beat this, the return and the risk adjusted return of an asset that is designed to increase in value over an extended period of time, then you have work to do. You have done that, so I don't worry from that regard. I just think it's interesting because a lot of people go hard on themselves when, you know, they say, I've had a really poor performance this year, I've done 20%, and I'm like, do you realize 20% is actually fantastic? Now, it can be argued if you're trading with a personal pot of capital, 20% on, you know, 5 grand, it's probably not going to do much for you, right? So you might want to go a little bit more aggressive. But on larger capital, and if you're trading with institutional funds, then yeah, 20% is absolutely fine, or absolutely fantastic, I should say. Flow Trader, yes, of course you can share a pic. Just paste it in the chat. Okay, so let's take a look at DRYX. Neil and Sebastian, I appreciate you guys jumping in. I will see. Today's session's going to be a little bit shorter anyway, so I think what we'll do is we'll just blast through all of them. I'll take a look at all of them so that you all get looked at. So we've got 40 minutes. So I am going to have to blast through a lot quicker than I usually do. So what I would suggest is I will take a look at them at face value. We'll go through some key metrics. But then I would take a look back at one of our older sessions. So from like last week or the week before, perhaps, and take a look at like one in real depth where you see, because I usually spend over an hour on one Darwin, but I literally have another 40 minutes today and then I have another call. So I won't be able to spend like 3 hours going through all three. But like I say, I'll try and cover everything within the next 40 minutes. But if I miss certain metrics, you know, we have loads of previous sessions, and all you have to do is watch what I talk about, watch what I'm looking for and the things that I suggest, and you can apply it to your own Darwin as well. So massively appreciate all of you joining in the session and asking me to take a look at your Darwin. If you want me to dedicate a whole session to it, for sure, like I can do one in private, or if you join the session next week, I can do it then as well. But we'll try and take a look at all of them today. So we have DRYX, Darwinex, PGBN, and we also have DALY. I feel like I recognize that Darwin as well. Okay, Alan, I wish it was more. I made some changes to my strategy after April and had 2 to 3 rough couple of months. Don't wish it was more. You've already hit the baseline, like I say. Just use everything as a lesson. Focus on improvements moving forward, and don't worry too much about that. Goal is long term, and I still have room to grow. Fantastic mentality to be in. Flow Traders just sent a picture in, so 2 seconds. So deleverage. Your deleverage actually isn't that high, to be fair. Are you sure you was risking 10% per trade? It doesn't look like you were risking 10% per trade. The way your equity curve goes, if you were risking 10% per trade, I'd be expecting an 80% return, not an 8% return. So somebody's just put in the chat about a scam account of me, so I was just replying to them. No 10 lots. Okay, I thought you said 10%. Yeah, you said 10% per trade, but you must have meant 10 lots per trade. Uh, Asking to bring it down 10% per trade to reduce lot. Got you. Got you. Okay, that makes more sense. You'll probably be scaled down tiny bit or maybe scaled up because your deleverage is fairly low. But let's continue that conversation next week because we can see the actual metrics once your Darwin is created. But let's not make a decision until that point. After that, message me. I'll take a look at it properly. I'll understand how you're currently being risk adjusted, and then I'll give you some actual advice and feedback on whether you actually need to reduce your size or not. Okay, back to DRYX. So you trade FX, commodities, and indices. So these are my favorite metrics to take a look at because I think they really highlight some low-hanging fruits. I mean, I can already see one right here. So we can filter these down by family, so a group of assets, for example, FX, or we can look at them on a more granular basis. I like to do this, and I do spend quite a bit of time looking at assets. Of course, you need a bit of data, so I would always say a minimum of 6 months track record before you begin to make justified decisions. A year is perfect, but what I like to do here is I like to calculate my expected value per asset. So you can do it at group value, you can do it at individual asset value. First stage is figuring out where your edge is most present. Not every edge is going to be as prominent in commodities as it is in FX or indices and commodities as it is in FX. There's certain strategies that just generally perform better on certain assets, and we have to understand that. I think 6 to 8 months would be more representative on my best days because before I was messing around. Don't worry about that. Weird. Yeah, don't worry about that. Sebastian said didn't quite understand the risk engine multiplier at the beginning, but trying to bring it down and keep it stable. Okay, we'll take a look at that anyway in a moment. Nick T has said, hi, quick question. If I scalp with an average trade duration of 6 to 10 minutes on Darwinex 0, will that limit my ability to attract investors due to how strategies are evaluated? Thinking of starting a Darwin, thanks. It won't. However, generally, if you're scalping and in the market for less time, generally your alpha cap will be lower. Now, that's calculated based on the toxicity flow of your orders. So if you're in and out of the market, it's harder for larger capital to do the same and not get slipped. So without seeing your metrics and understanding what your alpha cap is, which we do calculate for you on darwinex.com, without seeing that, it's hard to say. But a swing trader who holds and sits in a position and clips smaller size over a period of time will likely have a higher alpha cap than somebody who scalps with, a small stop loss and stuff. That's not to say that you can't manage a significant amount of investor capital, but just generally, the scalpers have a lower alpha cap. That's not us saying that we don't like scalpers. It's saying from a realistic perspective, an investor who's got 20 million isn't going to be able to enter the market the same way that they would with a swing trader. It's not like Darwinex taking a bias of a specific strategy or specific approach. It's saying that it's physically incapable to facilitate large capital getting processed through the liquidity provider at that price point, the same way that the trader would. Okay, so the first low-hanging fruit here, right, is the majority of your trades are in FX. So it's 57% of your trades in FX, but it's the only asset that's caused negative return. Okay, now if we take a look at commodities, you've taken a third of the amount of trades. So there's 107 trades on commodities and almost 300 on FX, and you've had an 18% return. Now, at this point, I would be evaluating whether you just completely drop trading FX completely. If you can justify the reason as to why that is, whether you were messing about before, is AUM the word? So that AUM million number you said in the past will get bigger eventually the more you focus on long-term trades. It doesn't always work that way, but generally, like as a general rule of thumb, yes, the longer you hold a position, the higher your AUM will be. So I would be trying to understand why this has such a low expected value in comparison to your commodity trading or your indices trading. Again, there's a big discrepancy there, right? Is you've taken pretty much the same amount of trades on commodities and indices. However, on indices, you made a 5% return. So if you broke that down per trade, I'm not going to try and do the mental maths here, but let's say it's a 0.05% return per trade on average. You then do the same calculation on commodities and you're looking at like a 0.18% return. So it's 5 times stronger or 4 times stronger or 4 times more expected value per position. And you're kind of trying to understand here, okay, where do I actually perform well? What assets do I perform well on? Again, the longer your record, the more trades you have, the more accurate you can be with this. For example, don't start looking at this if you're 2 weeks into building a record and you've taken 5 trades on FX and 2 trades on commodities. Of course, the data isn't going to make sense. But when you have 12 months worth of trading, it's easy to start picking patterns. And even if you don't make a decision now, you can notice these patterns and monitor them moving forward. So what I would be looking at here is, even if you don't drop trading FX, I mean, look, 120 out of the, so you got 300 trades, 120 of them on euro dollar, and you've actually made a positive return. Whereas all the rest are pretty much going to be negative, I would imagine. So not only are you losing money trading FX, other than euro dollar, you're stacking up commissions, you're stacking up potential swap fees if you're holding overnight, you're adding exposure to your books, which means your value at risk is going to increase, and it's unnecessary pressure, stress, and trades that you do not need to take, right? Of course, looking back, it's easy to say that. So we have to try and approach it from a forward-looking perspective. But I generally am a believer of, until you can prove that these patterns will change, I think they will continue. So if you're showing me that you make a much higher return in gold than you do trading Euro Swissy, for example, or any of these other FX pairs that you've got a negative return on, I don't think you're going to take a magic pill and somehow overnight that's going to swap and change and all of a sudden the data is going to align. I think there's a pattern for a reason. And I should probably caveat this with, before I become a trader, I was a data analyst. So kind of my speciality before trading was trying to spot patterns in large sets of data, lines of, millions of lines of data, trying to find patterns and understanding the data behind that. So I don't say this as like a newbie. Like, I understand data and I understand the patterns and logic in data. So as I said, even if you don't make a justified decision tomorrow or today and go, I'm going to stop trading FX, understand that there's a pattern there, because eventually you are going to have to make that decision. Now, me as a trader, I have a family. I am always looking to reduce my workload, reduce my exposure from a risk perspective, yet make a higher return. And again, it's hard to say looking back retrospectively, saying, well, if you hadn't have traded FX, your track record would have made more, you'd have made more money. Well, that's great. We know that, but we're not a hindsight warrior. But moving forward, can you make a change? Is this pattern going to continue? Are you going to make another 18% on commodities in the next year? Are you going to lose another 6% trading FX? All about knowing where your strengths and weaknesses are, right? The same as, like, if you think about a football player, right? If you have, I don't know, if I'm not gonna use football as a actually, no, football's probably the best example. Let's say you have every footballer on that pitch has their position. That position is their speciality. They understand where they need to be, they understand where they need to go, and they understand what role they play within that team, right, to get the best outcome every game. Now, if you started moving those players around, what do you think is going to happen? They're going to fall apart, because you're not playing them to their strengths. And you have to do the same as a trader. You have to understand where your strength is, where your weakness is, and you have to try and swerve the weaknesses as much as possible and play into your strengths. And even looking at variables like the assets that you trade, I think is a massive, massive thing that every trader should look at. Because like I say, people take a pattern and they say, I'm going to apply this, this pattern is great, I'm going to trade every single one that I see. And they don't differentiate the asset that they're trading, or the time frame that they're trading, or where in the chart they're trading it, or the macro background of what's happening in the world right now, or the geopolitical risks. They literally look at a singular pattern, which might be the entry model to your system, but it's not the whole story. And so anyway, all that to say, I'm spending a lot of time rambling, and I know we've got three Darwins to look at. I don't think we'll be able to look at all 3 of them, but like I say, if you if you want me to do like a private session, please feel free to direct message me on Discord or message us on a social media platform. I'm happy to do that, or you can come back next week and I'll do your Darwin next week as well. Lionel says, why does the dashboard take a long time to update? I presume you mean the home dashboard. If you refresh it, it should update, or at least mine does anyway. Flow Trader said, would there be an issue if I take the same approach trading other assets due to correlation if I use the same strategy? I assume no. Not sure what you mean by that. Mean correlation within your own system, or if you mean Darwin correlation between different Darwins? Not sure exactly what you mean, so please elaborate for me. And said, a lot of my best trades is held overnight in swing trading, and gold has been good as well as oil. In FX, euro dollar has been good. Yeah, can see that. It's true, I like trending assets. They are usually good to me. Okay, I mean, yeah, I think for some people, trading trending assets or trading assets that are designed to go one way is half of the battle, right? Determining bias is really, really hard. And so if you like an asset that trends, generally trending upwards, then, you know, solves half of the game, right? But anyway, going back to this, I think there's so much exposure that you can save yourself moving forward. Like I say, you can probably cut 200 trades out of this, just from getting rid of all the FX pairs other than euro dollar. It's clear that you have an edge on euro dollar that you don't have elsewhere, and really just focus on where you perform well. And again, this is just what I would be doing. You don't have to take this as gospel. There's always contingencies here, right? Like if your main system is around gold, but you want to offset the risk of trading gold in a general direction, you might be trading Aussie Swiss, you know, with Australia being the largest exporter of gold, with Switzerland being the largest hoarder of gold. So you might be trading that pair as a hedge against your gold trading, and therefore your Aussie Swiss positions might be in the bin all the time. However, it's offsetting the risk of your gold positions. So there are going to be contingencies that you have to take into account. However, I don't know those contingencies. I'm looking at these at face value. The question is, discipline and rules followed with these other assets. No, the correlation is based on your return and drawdown. So realistically, that should be different. I wouldn't worry too much about that. A lot of people worry about Darwin correlation more than they should. It's very, very difficult to be correlated for a large period of time. Lionel said, it takes a while for the statistics to be displayed. It lags by 1 day. Mine doesn't. I mean, your quote updates in real time. Usually I refresh my page and my return gets updated in real time as well. Well, at least when I refresh it. But the statistics below, I mean, I don't know why it takes a while. I don't know why it lags. I don't really have an answer for that, to be honest, other than I can speak to the team and see if we can get it to update more frequently. I know that there's a minimum refresh of every day or once per day, but I don't know if we can increase that. Okay, so I can use the same approach for different asset sectors. Yeah, of course. Just ensure you're not taking the exact same trade, right? There's just no point in having multiple accounts doing the same. Moving on, trading time distribution. So the problem with this metric, and every week when I talk about this, I kind of go off this metric more and more. And that's because where it says number of trades, it classes an open and close of a position as its own trade. So where it says 671, it's actually not 671. It's probably half of that. Same with 222, same with 155, because it's classifying an open and a closure of a position. The problem with that is when we look at your Asian session here, is we don't know, is it negative because you close your trades in a loss at that point, which is fine, or is it a negative because you're opening trades at that point and they turn out to be losing trades? It's really difficult to distinguish. If you say, I only trade during this session and I run the trades into the US session, and the US session is negative, but the European session is positive, well, then you know that you should stop cutting your trades, or start cutting your trades rather, before the US session. Okay, because you can see that the longer you hold your trades, generally, the more times they reverse or the more losers you take. Alan said, I don't trade Asia. So the Asian session, you probably don't, but I think this is GMT. So Europe is 9. I can't. again, I can't remember how this relates. I think we're in the UK, we're GMT +1 maybe, or +2. I can't keep track of time zones because they change twice a year. But that will just be London Open basically. But it's like the back end of Asia. So this is telling me, with that in mind, the fact that I'm presuming that's you entering first thing in the morning. Generally, that's where you probably take the most amount of losers, and the longer that you're in a trade, the higher the payoff, which we can take a look at in a moment. Yeah, I can open trades just before London Open. Okay, but I mean, I technically would still class that as London Open, right? Even if you're just in there before London Open. This is my favorite statistic by far. I think it's overlooked by a lot of people. You can go really deep into this from a meaning perspective, as in you can really find out a lot about a person by this statistic. Swingmaster, there isn't a way to change your ticker name, unfortunately. I wish there was, because we get asked that a lot. Maybe I can push that back to the team and see if it's something that we can do. But at this point, I don't think it is. The problem with that also is, like, people can just keep changing their tickers and hide their records basically. But the interesting thing here, right, is for you specifically, if we were to remove Tuesdays, and again, this is retrospective, so this is looking back, being a bit of a hindsight warrior. If you didn't trade Tuesdays, you would be pretty much flat for the year. You wouldn't have made a loss, you wouldn't have made a profit. You've got 3 negative days. Your Thursday is just above break even, right? But then your Tuesdays, you've made a huge return. And this reminds me actually of THA, which is the Darwin that currently manages like $21 million through Darwinex. And I'll show you what theirs looks like. And this is going back to my point about spotting patterns and understanding that generally, until you can prove that they're going to change, they probably won't. If we scroll down, THA's looks very similar to yours. Now, there is a bit more dispersion on these other days. However, there's one huge outlier. Okay, and now this can come down to a number of different things. If you haven't got much data, it can be an anomaly. It can just be the way it is. It can be strategy related. So if you are a swing trader, you might get your best returns from trades opened on a Monday, right? If you're a mean reversion trader, Mondays and Fridays might be your worst days, because the mean reversion of the week might have happened on the Wednesday, which is generally what happens from my perspective anyway. And therefore, there is a reason for your strategy to perform better on certain days. Okay, like for example, if we know that it's going to be a bullish week, generally the lower the week, the highest chance for that to be formed on a day is Monday or Tuesday, let's say. So Tuesday is probably going to be your better day from a return perspective. And so your strategy does influence this. However, there's also a personal/routine element to this as well. And believe it or not, these are real conversations that I've had with real traders when looking at these. You have things like, Wednesday is the only day of the week that I take my daughter to school, and I only trade the London session. So I'm always rushing out the front door to get my daughter in the car. And as I'm rushing out the front door, I always long $1. Okay. And then we look at their Wednesday return and we go, well, that doesn't make sense, because Wednesday is your poorest performing day. How about you just stop trading when you're rushing? Okay. Like I say, real conversations that I've had with people. Another one was, because people always laugh at me when I use these examples, right? But like I say, they're real examples that I've had with through conversations with traders. Whether these are the reasons behind why their performance was so poor on certain days and better on other days, I don't know. But it's what we drilled it down to at the time. I had a guy whose Friday was really poor, but the rest of his days were pretty steady and pretty decent. Turns out he would go to the pub on Friday after he'd finished his training week, and he would end up, having a few beers early Friday afternoon and take some shit trades, some rubbish trades, in the afternoon, and basically flunk their whole week. And so the point that I said to him was, why are you doing this same thing that you know is bad for your performance? But the problem is they didn't know it was bad for their performance. Paladin, I'm presuming you're laughing at me. I mean, I usually don't slip up on these. I think that's the first time I ever had. But I'm a human, like it is what it is. Is there a way for us to get the trade file to import to TradeZeller? I'm presuming you can just import your broker statement, right? Which you can pull directly from MetaTrader. Uh, I'm presuming you're asking that because I think TradeZeller's having issues with their MetaTrader integration right now. I'm presuming that's what you're asking. But going back to my point was, yeah, so you should be able to just export your broker statement from like directly from NT4 NT5 and then import that. No problem. My point was, the trader did not know that he had a pattern of underperformance on a Friday, and he was actually a good trader, but he wasn't taking note of his stats. He didn't know, and I mean, it's here for him, right? He can see it clear as day, just like we can see this chart. But lack of journaling, exactly, or not even lack of journaling, because if you use something like TradeZeller, EdgeWonk, or even with Darwinex, the statistics are there for you automatically for you to see, right? But if you're ignorant to it and you're not trying to spot these patterns, then you don't know it's there. Because let's say this guy, for example, who was, maybe getting a bit tipsy on a Friday and taking rubbish trades and, affecting his performance. By the time Monday rolled around, he'd forgotten all about that bad trade on a Friday. Okay, so it wasn't in his mind, especially in his case, because he'd get drunk, he'd go home, and then he'd forget all about his trading week because the next day was the weekend. So he was in this loop of not even knowing that his performance was going down on a Friday because he was too drunk to care. And so what I said was, delete the app from your phone, go to the pub, enjoy the time with your friends, have that where you switch off. You're going to be doing less work for a better or higher reward, because it was very, very rare that he would win a trade on a Friday. And so I always use that example because it doesn't have to be strategy specific. It can be something super personal to you, that only you would experience, only you would understand. And like I say, it can be something as simple as rushing out the door to take your kids to school, going to the pub with your friends. Maybe you work on a Wednesday at a part-time job, but you don't work the other days of the week. So many different things that happen to you in your life that is unique to you and that can give you kind of clarity and answers as to why this looks like it is. Because here in your example, there is a very, very, very clear discrepancy between your performance on a Tuesday to the other days. You might say, I don't know what it is, or why it is like it is. And to be fair, it's been pretty stagnant since back here. So I would say that you probably just had a lucky streak on Tuesdays at this point, right? Because it's been pretty stagnant since. But even then, if we still drilled it back to here, there's still a clear discrepancy in performance. So take a look at your trades. I hope you have a journal, but review them. Take a look at your Tuesday trades. What is different in those trades? Is it something strategy specific? Is there a variable that you can notice week in, week out that is constantly appearing on these trades that are profitable compared to your trades on, let's look at your worst performing day, which is a Friday. Compare the two. Get your top 10 losers from a Friday and your top 10 winners from a Tuesday. Compare them. Look at them side by side. Print them out. Like go back to basic. Live like a caveman. Get a printer. Print these images out of the charts and analyze them side by side. Is there something different? If not, it might not be a technical issue. It might be a routine issue. It might just be a strategy thing. But I think it's quite interesting that you're really only profitable 2 days, but out of those 2 days, it's really only one day that's kind of carried your record. I would say it's alarming. It's a bit of a worry because if you start to underperform on a Tuesday as well, the other days aren't coming to save you, basically, based on the past year of your performance. So I'd just be really aware of that. And also, be aware of it when you're coming into the market on the morning. If it's a Tuesday, you know that's your highest performing day. Going back to my point about expected value at the beginning, something that I like to play around with myself and I recommend to a lot of people. Oh, people are saying they can't hear me. Let me. Can you hear me now on Discord? Hopefully you can. Still doing it. Wonder why it's doing that. Let me change my mic. Is this any better? I hope that's better. I've switched my mic on Discord to my webcam, so it should sound better. But I've kept it on my actual microphone for the guys watching on X, YouTube, or Instagram. So I'm going to continue, but please let me know if there's still issues with the audio. I also want to apologize for the two guys who were waiting for me to look at their Darwins. I don't think we're going to get a chance because I've been rambling for a long time. So what I can do, just please let me know what you would prefer, whether you want to do a private session or whether I do a recording, or whether you want to come back next week and we can do a live example then. Just because I don't think we'll have time today because we've got like 13 minutes left. So something that is really, really important, and I tell a lot of people, is implement something like a risk barometer. So everybody's leaving the Discord, so I presume it's still doing it. Implementing something called a risk barometer. Now, with a risk barometer, basically what we're doing is we're measuring your expected value. You have a baseline of 1, which doesn't necessarily have to mean 1%, but what it means is that is the baseline risk. So it could be 1%, 0.5, 2%, 10%, whatever you want that figure to be. When you have a trade that is on the lower side of your expected value, maybe it's trading an FX pair, which historically you've been poorer at trading. Maybe it's in the Asian session when your return, the only session where you got a negative return, and maybe it's on a Friday, right? We go, well, it's my worst asset, worst day of the week, worst trading session. I'm, either going to skip that trade, or even if I'm still going to take it, should I be risking the same on that trade as I would if I was trading gold during the European session on a Tuesday, which is probably your highest expected value trade, where you go, it's the most profitable asset that I trade. It's in the session that I make the most amount of my return, and it's on the day of the week where I've cleared all the other days. By far your highest expected value. Should you be risking the same on both of those positions? I would argue no. A lot of beginners argue, no, you should risk the same per trade because that's what you should do. It's what everybody says to do. But actually, when you start talking to professional traders, nobody operates that way. And I always put it down to, if you're a professional poker player, right? And trading is like poker, regardless of what you want to believe. Trading is like poker. It is. I'm going to close down the Discord session. Hopefully that will give me better connection here. Trading is gambling. Okay, there's edge involved, of course, but essentially you're putting down a risk to generate a return on an uncertain outcome. That is quite literally the definition of gambling. Whether you subscribe to that belief or not, kind of, it doesn't, it's kind of up to you. However, I think they're exactly the same thing. I think trading is gambling. I think poker is gambling, even though you can have edge in both. But a poker player will never bet the same amount of chips on every single hand. If they have a poor hand, which just means they have a poor set of cards, which means they have a lower chance of beating the other players at the table, they're going to bet with less chips, or they're going to fold, meaning that they put their cards down, they lose their initial bet, and they step away. Okay? Whereas when you have a good hand, maybe it's a flush or whatever it may be. I'm not big into poker. I know kind of the basics. But when you have a good set of cards and you have what they call a good hand, you're going to push size. You're going to bet more chips because there's a much higher chance of you beating everybody else at that table. There's also a lot of psychology involved in poker as well. If you bet large, the other players are sitting there going, this guy's either bluffing or he's got a really good hand. Do I want to take the risk when my cards aren't as good as his, or I don't think they'll be as good as his? I'm not going to take the risk. I'm going to fold and, lose my small bet. I'm not going to bet big and fight back because I just don't have the edge at that point in time. And trading is exactly the same. Find where your edge is, find where your edge isn't, and bet accordingly. And I don't mean bet 10% per trade where you have a higher edge and then bet 0.1% per trade where you don't have an edge. But make sure there's a slight variance. Baseline's 1, push it 125, push it, 7.5. So like, if let's say we did use the baseline as 1%, then maybe your good trades you risk 1.25% or 1.5%, and you slightly push it. Put your foot on the gas when you have a higher expected value. When you have a lower expected value, risk 0.75 or zero point 0.5. Slowly bring it down the scale. Again, not everybody agrees with me on that, but I think it's really, really powerful when you have data like this, that you can take away these patterns and you can understand where your edge is. I think it's kind of a cheat code. Anyway, moving on. We got 10 minutes. Let's go on to strategy analysis. So you've taken 524 trades, 62% long exposure, which makes sense in as though you're trading indices and gold, and you said you like trending assets. So I presume over the past year, you've probably been long both indices and gold for the majority of the time. Daily trade frequency 2.19, so not too active, but still, pretty much in there every day. 43.89% win rate, so you have a 44% strike rate with a average payoff ratio of 1.53. Okay, so you do have a good win rate to payoff ratio, which is great. Of course, if you've got a 50% win rate at a 1-to-1 risk to reward, you're not going to lose, you're not going to win. You're slightly below 50% win rate with a slightly positive payoff ratio. I would like for you to try and extend the gap between those slightly, whether it's bringing your win rate up without affecting your payoff ratio. For example, if you could bring that up by 2-3%, maybe 6% back up to 50% win rate and keep the payoff ratio 1.53, fantastic. If you can push your payoff ratio up to 2 without having to sacrifice any of your win rate, again, phenomenal. Of course, that's all hypothetical. You're going to have to put in the work to try and get that done. But there's really only a few things that you should be worried about as a trader. How do I win more from my winners? How do I lose less from my losers? And how to generate more winning trade ideas. That I paraphrase from Tom Dante or Trader Dante, so I'm not going to take credit for that. That is something Trader Dante says, but I think it's really, really important. You can get lost in the noise of all this, rubbish in the industry. You've got 3 goals: win more, lose less, make more trades, or more better trades. You have a good duration ratio of 1.91. So that basically means you hold your losing trades for 4 hours, whereas you hold your winning trades for 8 hours, giving you a positive duration ratio. It doesn't mean a lot for profitability. Like, a good duration ratio doesn't necessarily mean you're going to be more profitable. But what it does show me is that you're more willing to cut losing trades early, and you're more willing to hold winning trades for a longer period of time, which we can see here. I mean, this is quite uniform, right? This is your duration versus profit chart. Essentially, I use this again to measure my expected value. So how long I'm in the trade. I should say this measures how long you're in the trade and how many pips you take. The red are negative pips, the green are positive pips. So you can see this first square here is any trade that you closed for a return of 0 to 10 pips in the positive, or within a 30-minute window. So within the first 30 minutes of trading. Okay, and I try and find, okay, what's my win rate and my payoff here within 30 minutes? What's my win rate and payoff within 60 minutes, 4 hours, 10 hours, 2 days? And I try and find, where do I make the majority of my return? And although it's not going to help you necessarily make better trades, it allows you to highlight periods of time where you what I call the danger zone, which is kind of where your trades have a high chance of being stopped out. So, for example, swing traders, generally the first 30 minutes is where they're wrong on their trade ideas. Scalpers, the longer they're in the market, the worse their payoff is. And so you can start to implement like time-based stops, or for the first 30 minutes, if you're a swing trader, where you have a 10% strike rate, so you lose the majority of your trades within the first 30 minutes, but then after that, it just keeps going up and up and up. You can kind of take a relax after that first 30 minutes. And what you can do is start looking back through all of your old losses again and go, well, a lot of my losses are concentrated within the hour to 2 hour ratio. So I'm going to analyze all of those trades. Were there any warning signs in those trades? That's kind of like a common occurrence. Again, we can't say, well, this one trade crossed this EMA, and so I should get out of all of them if they cross the EMA. Of course not. But if there is a common factor across so many of these trades within that one variable, then you can start to go, I'm noticing that on a lot of these losses within this period, that the same thing is happening, and it's not present on the winners. Could that be an early warning sign? Only you will know, but you have to put in the work, of course, to go back and review your old trades to know that. Max positive, negative excursion per position. I love this this metric, and I think it's that if you could have one metric as a trader, I think it should be this to focus on, because I think if you get this right, you can turn a losing trader or a break-even trader into a winning trader. The problem with this is it only tracks the data whilst you're in the trade. Okay, of course, like this is an automatically tracked metric here on Darwinex, so we can't measure what happens after the trade because we don't know what you would have done after the trade. However, I track this for my trades outside of Darwinex also, and I take a note of my maximum adverse or negative and maximum favorable or positive excursion outside of Darwinex, because I basically want to know how far my winning trades move for me. Okay, so if I'm taking 10 pips on a winning trade, for example, but they're all running 30 pips, I don't know that I'm like leaving 20 pips on the table every trade until I go and look at my data, and my data tells me you're leaving 20 pips on the table every trade. Extend your targets. Fantastic. Such a low hanging fruit. I also want to know how far my winning trades move against me. Because if on average my winning trades only go against me 10 pips, but I have a stop loss of 20 pips, well, you know that you're risking 10 pips more than you need to. Because the only trades that went past the 10 pip mark of drawdown were losing trades. Well, okay, let's bring our stop loss up by 10 pips, essentially allowing you to double your position size. Rob says, Kieran, the demo accounts are different. Can we have the same data as we do on EXZW? Darwinex here as we do for demo. What do you mean, dude? The demo accounts are... The accounts are different with the same data. I'm not sure what you mean by that, mate. We are going to have to wrap up here, though, guys. So I mean, I don't even know where the hour's gone. I think we had a bit of a conversation at the start, which was great. And usually I don't have calls scheduled after today, but I have a call with somebody in the US, and so you know, have to work around their time frame today. So for the guys who I didn't get a chance to go through your Darwin, I will either do it next week or inbox me on social media or on on Discord, and I'll be happy to do it in private or send you a recording of your Darwin and take a look at that for you. In terms of your account, Alan, I'm guessing it's Alan. It might be Alain. I'm not sure. I think you just need to keep doing what you're doing. I think you've got a really good start. There are some low-hanging fruits and there's some things for you to explore, but it's more to find some answers at this point in time. Why is your Tuesday return so much higher than the other days? Why is your gold return so much higher than the other days? And then really play to your strengths on that. So guys, I am going to love you and leave you all. We will be back tomorrow at 4 p.m. UK time for a Darwin explanation session where I go through value at risk, exposure, VAR, all of those sorts of different things in much more detail. So I highly recommend joining that session. If you feel like you wanted to know more about the metrics, which I completely understand that we haven't done as much today as we usually do, like because there's been a lot of questions and a few people wanting their Darwin being analysed. I would recommend to go and watch last week's session, which are all available on our X account or on our YouTube. I would go back and watch last week's session because you'll see the rest of the metrics that we explore. And you can log into darwinex.com with your Darwinex0 username and password also. And there's a whole load of metrics on there. But again, I go through that in last week's session and the week before and the week before and the week before. Alan says, thank you. It was very informative. I appreciate that. But like I say, I would highly recommend going and watching last week's session and seeing the other metrics that we go over because you can easily relate it back to your Darwin, especially after the variables that we looked at with the assets and timeframes and stuff. That's more personalized. But anyway, guys, thank you all for attending. Thank you all for your questions and for everyone putting their hand up. Usually I'm struggling to get Darwins to analyze. So today we've had like 3 or 4 people put their hands up. Unfortunately, we've run out of time, but I'm going to love and leave you all and hopefully see you all in tomorrow's session. If not, have a fantastic rest of your evening, day, morning, wherever you are in the world. Have a great rest of your week and I'll catch you in the next session. Peace out, guys.